Good morning, team. Good morning, everyone. So, let's continue our journey with the forex exposure and management. In the previous session, we have discussed about how we can cover ourselves, our position in the foreign market. So, if you have an exposure, if you have bought a certain foreign currency, you can cover by selling the same foreign currency through a market. So, this will help you cover your position and there will not be any exposure which will be left uncovered then. Today, we are going to discuss a few more questions on this. And so far, what we have done is we have looked at the interbank rates and we have seen that the bank has not taken any margin. But in this particular question, we'll start our session. This question will be having a exchange margin as well. So how you deal with an exchange margin, we will see this. Let's look at this question. On January 28, 2013, an importer customer. So who's the customer? He's an importer. He has requested a bank to remit Singapore dollar. How many? 25 lakhs or 2.5 million under our irrevocable letter of credit. So in international market, whenever there is an export or import, just to be on the safe side, letter of credit is one of the ways in which the importers and exporters secure themselves for the payment. However, due to unavoidable factors, the bank could remit and could effect the remittance only on February 4, 2013. So the two dates involved here is January 28. On actual transaction happened on February 4. The remittance could be affected on February 4. So there must be some fluctuation in the exchange rates between January 28 to February 4. That fluctuation may have caused a loss or a gain to the importer. Now, importer customer is an Indian customer. An Indian, if he is an importer, means there will be payables. So he has to pay which currency? Payables in Singapore dollar. How many? How much amount? So you can see here, it is 25 lakh. Under a irrevocable letter of credit. Now, if you have Singapore dollars payables, what is the applicable rate for you? Is it bid or ask? So you will ask for Singapore dollars. You will use ask rate. You have to buy the Singapore dollars. So ask rate would be applicable. So what is your requirement? Which exchange rate do you require? You require your home currency, rupee by Singapore dollar. And rupee by Singapore dollar, you need the ask rate. Okay, this will be the rate applicable for you. Let's see what was the rate on January 28. Now, do we have a rupee by Singapore dollar here? No. What we have is the cross currency rates would be applicable. The first rate that is given to you is rupee by dollar. The second rate is Great British Pound. Pound 1 is equal to US dollar 1.7840 and 1.7850. So the second rate available is dollar by pound. But we don't have the Singapore dollar as of now in these two rates. So we'll use a third rate to calculate the Singapore rupee rate with Singapore dollar. Another exchange rate given to us is the Singapore dollar against pounds. Now this rate is Singapore dollars with pound. So you can see here, if you want rupee by Singapore dollar, you can use this rate in the numerator. You will get rupee in the numerator. You can use this rate multiply by this rate. So the dollar would cancel. After you multiply these two rates, rupee by dollar, and dollar by pound. This two gets cancelled and you are left with rupee by pound. But you still need rupee by Singapore dollar. Now, if you look at this rate, rupee by pound, which you have got, and you multiply it by Singapore by pound, you will not get the desired rate. So you have to inverse it. So if you will inverse this one, you will end up getting your required rate, right? So this has to be in the numerator, multiplied by this has to be in the numerator, multiplied by this in the denominator, right? And we need what? We need ask. So 1, 2, and because we need this in the denominator, we need 1 upon bid, right? So how will you get this rate? Firstly, you need to get rupee by dollar ask multiplied by rupee dollar by pound, again ask, and multiplied by Singapore dollar by rupee by pound, 1 upon this. So this will be bid, right? This will become bid. So final answer on January 28 will be 45.90 multiplied by 1.7850 divided by 3.1575, right? Similarly, now we don't need to calculate again what would be the factors here. On February 4 also, you will have 45.97 multiplied by 1.775 and divided by 3.1380, right? However, we need to add margins to this so that you will be able to find out how much you have to actually pay in rupees to get this Singapore dollar. Okay, we can do the calculations here. So on Jan 28, the applicable rate for Singapore dollar would be 45.90 multiplied by 1.7850 and divide by 3.1575. Further, take care. What is given is calculate the rate in multiples of 0.0001. So we will, whatever the answer you get, you will round it off to 4 decimals, and the pip is here 4 decimals. Okay, 0.0001. So this rate comes out to be on 28th January. The answer is 25.9482. 25.9482. This is the rate as on January 28. Similarly, we can calculate for February 4. What would be the rate on February 4? 45.97 multiplied by 1.775 divided by 3.1380. So the rate that comes on February 4 is 26.0394. Now you have to apply 0.125% exchange margin. Regarding exchange margin, be careful that if it is asked, that means you are going to buy the Singapore dollar. So you will pay the ask rate plus the margin. But if it was bid, if you were selling Singapore dollars, the applicable rate would be bid rate. This is what you will get minus margin. So the bank will deduct further some margin and pay you a little less. So while margin is applicable, if it is asked, the margin is to be added, and if it is bid, the margin is to be subtracted. For us, what is the requirement? Ask, which means that we are going to add the margin to the applicable rate which we have got to 25.9482 multiplied by 0.125%. So you can either multiply it by 0.00125 to get the margin amount. So the margin amount comes out to be 0.0324. Use it till 4 decimals also, round it off, and always mention, if it is not specifically mentioned in the question, you have to mention yourself that till what decimals are you rounding off your figures. Or you can general write that all answers are solved with rounding off to 4 decimal points until specifically asked. So 25.9806 is the applicable rate. Similarly, when you apply the margin on 260394, the margin comes out to be 0.0325. And when you will add this margin, the applicable rate would be 26.0394 plus 0.0325. So the final answer is 26.0719. So what are the two rates which we have got? 25.9806. This is what we were supposed to pay as on 28th January 2013. And now the rate that is coming out is 26.0719. Okay. So this is your final answer in the sense what rate would be applicable. But we have to ultimately calculate how much does the customer stand to gain or lose due to the delay. So what's the loss or gain? Now this was what you have to pay. You had to pay 25 lakhs into 25.9806 if the letter of credit had been or the remittance had been given by the bank on 28th January. But if the remittance was delayed till February 4, the applicable rate became 26.0719, which is a little more. So you will end up paying 26.0719 into 25 lakh. Okay. So let's see how we are going to solve this. This is the basics which we have done here. And using this, this is how you're going to present your answer. And on 4th February, we buy dollar. Ask, ask, bid. Let's add bank margin. So this is how you have calculated the final rate. You will use the rates here, multiply the 3, you will get the exchange rate, add the margin, and finally you arrive at 25.9806 and 26.0719. rupee payable, 25 lakh or 2.5 million multiplied by 26.0719. Fifty-five lakh 17,9750, and here 25 lakh multiplied by 25.9806. This comes out to be 64 lakhs 95,015, 6495150. So you will compare how much is the difference in payables. So 25 lakhs into 25.9806, you end up paying 6 crore 49 lakhs 51,500. And if the rate applicable is 26.0719 together with margin, you end up paying 6 crore 51 lakhs 79,750. So how much extra did you pay? That which is the final question which is being asked. 65179750. So you end up paying 228250 extra. Loss due to delay, 6 crores 51 lakhs 79,750 minus 6 crores 49 lakhs 51,500, which is equal to 228250. So the loss is 2,28,250 rupees. Okay. This is how we're going to calculate the final answer. If you have understood, we can proceed forward. If there is any question or any doubt, please ask. Moving on to next question. So we have understood how we can calculate the applicable rates. Either we get it directly or we get it through cross currency rates. We also have understood how to find out whether a bid rate or a ask rate would be applicable to us. Okay, thank you, Leela. So next question here is to find out how much is the exposure, and we can also see whether there is any exposure positions which are offsetting to some extent. So this is a very simple question here. Question is, following are the details of cash inflows and outflows in foreign currency denominations of a company which is an Indian export firm. So there is a company and this is a Indian export firm. It has no foreign subsidiaries. So there are transactions with other firms or other companies or entities in different countries because this is the Indian export firm with no subsidiaries. So we have to find out, number one, what is the net exposure for each foreign currency in terms of rupees? what is the net exposure? So what are the different currencies this firm is dealing with? It's exporting to US dollar, it's exporting to France, to UK, to Japan. So these are the four currencies. And it's not just that there is an inflow, though export firm is there. So you will say that it must be exporting goods to the other country, and therefore there would be receivables or inflow. But there is also an outflow in the same currency for some reasons. So we have to see what is the exposure, net exposure, and we have to see whether there is any exposure positions offsetting to some extent. So before I go ahead with this, let me tell you how we calculate the exposure. And when we say net exposure, this is a concept which is netting. Netting means you have to see how much is the inflow versus how much is the outflow in a particular currency. So subtract the two, either you will have a net outflow or you might have a net inflow. Money would be coming in that currency or it might be going out. So that means outflow means you have payables and inflow means you have receivables in a foreign currency. So important thing here is that if the net outflow is there, if they're netting, after netting, we have the exposure as payables, that means we have to pay dollars for the first currency, if it is, let's say, US dollar. So if the currency is in payables, exposure is outflow, we are wondering, we are a little fearful that USD may not increase. So the currency may not be at premium. So the fear is that the currency should not be at premium if it is payables, because that will create a loss for us. For example, if the dollar is 80 rupees, $1 is 80 rupees, and you had to pay $1,000, what would have been the outflow? 80,000, right? Now, if this increases, price of the dollar increases, $1 become rupee 90, which means the dollar is at premium. So the same payables 1,000 would mean an outflow of 90,000 rupees for you, right? How much you were supposed to pay? $1,000. So the total outflow was 80,000 rupees. But if when you are actually making the payment, the price of dollar fluctuates and the exchange rate is now $1 is equal to 90 rupees, this indicates that your $1,000 outflow will now be not 80,000 but 90,000 rupees. So there is a loss of 10,000 rupees to the Indian exporter. However, if the same was receivables, so earlier you would have received 80,000 rupees, let's say on the transaction date. But now when you are actually receiving the payment, or when the time comes when you have to receive the payment, because the dollar has increased, the dollar is at premium, you end up getting more, end up receiving 90,000. So it becomes a gain of 10,000, right? So if it is payables, you fear that the currency should not be at premium. And if it is receivables, you fear that the currency should not be at a discount. The foreign currency should not be at premium in case of payables, and the foreign currency should not be at discount in case of receivables as compared to your home currency, right? So payables means we are happy if it is at discount. Receivable means it is good if it is at premium. So let's look at the exposure in this question. For US dollar, our net exposure is you have 40 million or 20 million outflow. 40 million is inflow, 20 million is outflow. Okay. 4 crores or 2 crores. So the net exposure is there is a inflow. So I will indicate inflow with a plus sign, a plus inflow of 200 crores. So this is, in a sense, receivables, right? So you have 200 crores receivables. What is the spot rate? 48.01. What is the forward rate? 48.82. Is the dollar at premium or at discount? Here, the dollar is at premium, right? So earlier you were supposed to receive 2 crores into 48.01. Now you're going to receive 2 crores into 48.82. How much is the difference in the price? How much is the premium? 0.81, right? 48.01 minus 48.82. You can subtract the two. How much is the difference in the exchange rates from spot to forward when you are actually might be receiving the payment? It is 0.81. So though you had an exposure in US dollar, but the position got offset to some extent because of the increase in the forward rate as compared to spot. So you had offset this position because the currency is at premium. The second currency, similarly, we can talk about is we had a French inflow of 2 crores, whereas the outflow was 80 lakhs. So what is the net exposure? Once again, you have receivables plus 1.2 crores, right? So the 1.2 crores, which was receivable at 7.45 exchange rate, French franc is 7.45 rupee per French franc, which has changed to 8.12. So again, the French franc is also at premium. By how much? 8.12 minus 7.45. Here the pip points are 0.01. So it's up to 2 decimals, 0.67, right? The third currency that you are exposed to is UK pounds. Inflow is 3 crores, outflow is 2 crores. Once again, you have more receivables to the extent of 1 crore or 10 million. So 1 crore, and again, this UK pound, which was 75.57, has now become 75.98. So the UK pound is also at premium. French franc was also at premium. US dollar is also at premium. And in all the three, your net exposure is a positive. So you have receivables. 2 crores receivable, 1.2 crores receivable, and 1 crore receivables. Here also you will gain because the UK pound is also at premium. How much? 75.98 minus 75.57. So 0.41. So ultimately, in all the three, the position net exposure of receivables has been to some extent offset because of the increase in the price of the currency in which you had the receivables. So the currency is at premium, which has given you a benefit. Let's look at the fourth currency that the Indian export firm is dealing with, which is the Japanese yen. Here, the inflow is 1.5 crores, whereas the outflow is 2.5 crores. So here, the exposure is again 1 crore, but this time it is payables, right? 1.5 crore and 2.5 crore. So you have payables of 1 crore. Let's look at the price of Japanese yen, 3.20 and 2.40. So the Japanese yen is at discount from 3.2 to 2.4. Now, because this Japanese yen is at discount, once again, your outflow was supposed to be 1 crore into 3.2, but now your outflow would be 1 crore into 2.40. So the outflow will be less. And once again, because the payables, the currency is in payables and it is at discount, you will again get a benefit of 0.80. 3.20 minus 2.40. Right? So this is the question. So the first question was determine the net exposure for each foreign currency in terms of rupees. So this is the part of first answer. Your net exposure is rupee 2 crores payables, receivables, rupees 1.2 crores receivables, rupees 1 crore receivables, and finally the Japanese yen, rupee 1 crore payables. Okay. And then you have to see, are any of the exposure positions offsetting to some extent? Yes. Why? Because the receivables are at premium and the payables is at discount. So in all the four currencies, the Indian exporter will stand to gain. Right? A simple question, simply subtraction and finding out whether your exposure is either a receivable or a payable, and then seeing if the exposure is receivable and the currency is at premium, you stand to gain. If the currency is receivable and had it been at discount, you stand to lose. So, for example, if this was not 1.5 but 3.5, so you had Japanese yen inflowing 3.5, outflow is 2.5. So, there would have been a net exposure of 1 crores receivables. And if 1 crore is received and the currency is at discount, you would end up getting lesser amount in terms of rupees. But here, the three currencies in which we have a net exposure, which is receivables, all the three currencies are at premium, whereas the currency in which the net exposure is a payables of 1 crore, there you are getting a benefit because that currency is at discount against the Indian rupee. So this is your net exposure, and this position has been offset to some extent because of the change in spot and forward rates, because the currencies were in premium or at discount. And good for the Indian export firm, all the currencies in which the exposure was in receivables, there the currency was in premium, and the currency in which the Indian export firm had payables, that currency was at discount. Right? I hope once again it is clear to all of you. Let's move ahead. Right? So far we have understood about all the current rate, exchange rate.
I have a question. Can you explain the answer of second part again of this question? Second part.
Yes, sure. So the second part says, are any of the exposure positions offsetting to some extent? So firstly, you see you have inflow and outflow. So first there is a offset because there is a netting. So you have a only net exposure is only 2 crores, and that is a receivable. Inflow is more than outflow. So the Indian export firm will have a receivable. Now, when you are receiving this US dollars, 2 crores, and the exchange rate has moved from 48.01 to 48.82, which means the US dollar is at a premium, right? I'll explain to you in this sense. Let's say 4 crores into 48.01. This is what you were supposed to be receiving, right? Spot.
Mhm.
And 2 crores into 48.01 was payables. So in the spot rate, what was the situation? You had a receivables of 192.04 crores and you had a payables of 96.02 crores. So far clear?
Yes, clear.
Okay. So 192.04 minus 96.02. Ultimately, you will be receiving 96.02. So this, instead of calculating how much is receivables, how much is payables, because you have 4 crores inflow, 2 crores outflow, we could have directly calculated net inflow is 2 crores and the receivable amount in the spot market is 2 crores into 48.01. You would have got the same answer, right?
Right. Yes, got it.
Forward rate. Forward rate, the same transaction will not happen at 48.01, but will now happen at 48.82. So this was your net receivables earlier, but now at 48.82, your net receivables would be 2 crores into 48.82. So your net receivables is 97.64, right? Which is a bigger amount.
Yes, 97.64.
So you are getting more in terms of rupees now. So 97.64 minus 96.02. So you stand to gain 1.62 crores. So though you had an exposure, but this exposure was offset to some extent because the currency in which you had a receivable was at a premium, 0.81. If you directly also multiply 2 crores with 0.81, you will end up getting 1.62 crore rupees, right? So this is your gain. So luckily for this Indian exporter here, the three currencies in which inflow is more than outflow. 4 is greater than 2 crores, 2 crores is greater than 80 lakhs, 3 crore is greater than 2 crores. So here there is a net inflow of 2 crores, 1.2 crores, and 1 crore. And these three currencies, all the currencies, the forward rate is more than the spot rate. 48.82 is greater than 48.01. 8.12 is greater than 7.45. 75.98 is greater than 75.57. So luckily, in all these three currency, the exporter will stand to gain. Why? Because the currency is at premium. The receivables are in a different currency, and that currency is in premium as compared to rupee, against rupee. Whereas the fourth currency that he is dealing is in Japanese yen, where the prices have increased from 1.5, where the inflow is 1.5 and the outflow is 2.5. So there is a payables here. Outflow is more than the inflow. So Japanese yen net payables are 1 crore. And luckily for us, if we had to pay 1 crore at the rate of 3.20, the outflow would have been 3 crores 20 lakhs. But if the 1 crore is now payable at 2.40, the outflow is 2.40 crores, right? So therefore, instead of 3.20, we have to now pay only 2.4. There is a net gain of 0.80 in this currency. So 1 crore into 0.80, you will end up getting a gain of 80 lakhs, right?
Right. Yeah, thank you.
Welcome. So we start with the assignment 2 here. And before that, I would like to take up one more concept which we have discussed in the basic. So, team, we have discussed interest rate parity, right? Similarly, there is a concept of purchasing power parity also. We will discuss about the relative purchasing power parity. Just as interest rate parity talks about the difference in interest rate, the purchasing power parity talks about inflation. So let's take an example. Let's say if a particular commodity, let's take apples for example. Now let's say apples are selling in India at rupee 100 per kg, and the same apples are selling in US at, let's say, rupee dollar 1 per kg. So as far as purchasing power parity says, the exchange rate between India and US should be this 100 rupee should be equal to $1. So the rupee dollar exchange rate in the spot market should be, let's say, 100. I have taken this example for simplicity, 101. Now, if the inflation in India is, let's say, 7%, and the inflation in US is, let's say, 3%. So the same apples, which was costing 100, let's say, per annum. So after 1 year, what will happen? The same apples will cost you 107. Is it okay?
Yes.
Add 7% inflation to the 100 rupee. And the same apples would cost you in US $1.03 per kg, right? So the forward exchange rate after 1 year should be 107 rupee should be equal to $1.03. So 107 divided by 1.03. Theoretically, the exchange rate should be 103.8835. So just as where the interest rate is lower, that currency is supposed to be at premium. In the same way, where the inflation is lower, that currency is at premium. So the exchange rate of dollar has increased from 100 to 103.8835. Okay. So that means the dollar is at premium. This should be theoretical exchange rate price after 1 year. So just the same formula we can apply. If we apply the forward rate using the purchasing power parity, it should be spot multiplied by 1 plus inflation rate in the domestic currency divide by 1 plus inflation rate in the foreign currency. So the earlier exchange rate was 100 into 1.07 divide by 1.0. So you end up getting 103.8835. if the forward exchange rate is not 103.8835, there would be arbitrage opportunities. And that can be exploited by any trader. So it will bounce back to the equilibrium price as per the purchasing power parity. Right? So this was the second theorem or second concept in the foreign exchange rate fluctuation. There is one more concept which is called the Fisher effect. So basically, we do understand what is the nominal rate of interest. So here, the nominal rate of interest, let's say prevailing in India, this 7% is basically the inflation. And let's say the rate of interest in India is 10%. So we can roughly say that this 10% is the nominal rate of interest, which will capture the real interest rate plus the inflation. So in US, the nominal rate of interest could be 3% plus 3% real and 3% inflation. So the nominal rate of interest prevailing in US could be 6%. So this is when we say Fisher effect, and when you take the nominal rate of interest, so it already encompasses both the interest rate fluctuation as well as the inflation. So if you will calculate the forward rates using interest rate parity and use the nominal rate of interest, it will automatically capture some element of inflation in it. And therefore, we don't need to separately account for the part of the inflation which is costing or which is causing the change in the exchange rate fluctuation. I'll explain to you, just take it here. And now let's just see the proof of this also. And let's understand the nominal rate at inflation. Supposing you have invested, let's say, rupee 100, and the nominal rate of interest is 10%. So what are you going to get after 1 year? 100 plus interest, right? At the rate of 10%. So you end up getting 100 plus 10. That means 110. Now, this 100 was allowing you to fetch apples. How much? 1 kg. So 1 kg apple was also costing you 100 rupees. So this 100 was, you were able to buy how many apples for 100 rupees? 1 kg. Now there is an inflation, let's say, of 7%. So the same apples are now costing how much? 100 plus inflation after 1 year, 100 plus inflation at the rate of 7%. Now, how much money you have? 110. And what is the price of apples? 107. So earlier you were able to buy 1 kg. Now you will be able to buy 110 divided by 107. So what was appearing as 3% real rate of interest and 7% inflation. You will see that the real rate of interest is not exactly 3%. It is a little less than 3%. So if you divide 110 by 107, you are able to fetch how many? 1.0280 kgs of apples. So your purchasing power has increased from 1 kg to 1.02 in net. So your real gain or real interest rate is 2.80%. So if you want to find out real rate of interest, the formula will become 1 plus nominal rate of interest divide by 1 plus inflation, right? So this will give you 1.0280. So 1 kg instead of 1, you are now able to get 1.02. And to get it into percentage, minus 1. So it's 0.0280 and multiplied by 100. So this is your real rate of interest. What appears as a layman from 10% is not actually 10, 3% real and 7% inflation. It's close to 3, but will always be a little less than 3. So the real rate of interest here is 2.8%, right? So now let's once again recap the three theorems which we have done. The first one is that we have the interest rate parity, which talks about the exchange rate fluctuations because of the difference in interest rates in the two countries. The country which has a lower interest rate, that currency would be at premium. The second was the purchasing power parity. We talked about the relative purchasing power parity. There we had spoken about that the inflation in the two countries can be different, and theoretically the forward exchange rate should be in such a way that the exchange rate differentials should account for the inflation. Once again, the country where the inflation is less, that currency will be at premium. The third one is Fisher effect, which says that if you will take the nominal rate of interest, it will automatically cover up both the real interest rate differentials as well as the inflation or the purchasing power of the two countries. So assumption in all this is that we want the price of the currencies in the two countries should not give any arbitrage opportunity, so that it should not be that person from one country exchanges the currency, makes an investment in the other currency and other country, and then reconverts it into back into Indian currency or any other currency and stands to gain. Similarly, neither inflation should allow you any arbitrage opportunity. So that theoretically, forward prices should capture the differentials in the interest rate as well as the difference in the purchasing power. We assume that there are no transaction costs in the process, basis that these theoretical prices have been calculated. Though in real life, the exchange rates are not just the impact of interest rates or inflation, but there are many other factors which come into play, right? Okay. So we start our next concept here in the exchange rate or foreign exchange exposure and management. And technically, we have understood only the basic concepts of foreign exchange. We are now looking at how we can manage that exposure. So, one of the important things for managing that exposure is to hedge. Hedging can be done in many ways. It can be internal and external. So let's look at first understand the basic concepts of hedging and exposure. Internally, we can do many things. Like, for example, if I am an Indian exporter, and let's say I'm exporting to US dollars, US also. I'm exporting to UK also. I'm exporting to Japan. These are the three countries where my exports are. So I'm worried about that US exchange rate against rupee does not remain stable, it fluctuates. Similarly, the pound against rupee, there is a fluctuation in that. Similarly, the Japanese yen and rupee, the exchange rate, once again, there is a fluctuation. They will not remain stable, and we have seen why they don't remain stable. Internally, if I decide that no matter wherever I export, my document or invoice currency is going to be INR. So whatever I'm exporting, I'm telling the US importer to pay these many rupees. I'm telling the UK importer, you have to pay these many rupees. Similarly, I'm also asking the Japanese importer to make a certain payment in rupees. So whatever the invoice has been raised, the invoice has been raised in my home currency. So I don't have to worry about any exchange rate fluctuation. My amount that I'm going to receive is constant. It is for the US importer to manage his exposure in rupees. It is for the UK importer to manage the exposure in rupees against pound. And it is for the Japanese importer to manage the exposure in rupee against yen. So it's not nothing for me to worry about because my document or invoice currency is the Indian rupee. So one of the ways is to cover your exposure is to raise the invoice in your domestic currency. So the first one is you can do raise the invoice in domestic currency. Another thing that can be done is netting. So even if I am exposed to dollars, let's say I have dollars 80,000 payables, and against different intercompanies, somewhere I have also 80,000 receivables, or even if 70,000 receivables or 100,000 receivables. So after netting, my exposure is reduced to the difference, which we have just seen in the previous question also, that you were exposed to four different currencies, you had inflow and outflow. So after netting, you have hedged your exposure to some extent, and maybe then you need to cover up only for the balance. Another thing is netting can be done where you have an intercompany transactions. Similarly, there is a concept where you say you can do matching. In the sense, if I have $80,000 payables and from other companies or from overall the environment in which I am operating, if I can match exactly 80,000 receivables, that would help me to reduce my exposure to nil. So if I can exactly match my payables against receivables, I'm not worried about the foreign currency fluctuation. So if think about it, if I have exactly $1,000 to receive and $1,000 to pay, so if the exchange rate fluctuates from 80 to 20 also, it doesn't make any impact on me. Whatever the dollars I have exactly the same dollars as payables, same as receivables. So whether the dollar is of 20 rupee per dollar or it's 80 per dollar or if it is 120 per dollar, it will not make an impact to me. Another thing that can be done is also you can change the price variation. So for example, these three importers do not agree to get the invoice in Indian rupees. So when the price of the dollar was 80, I raised the invoice, let's say, for $1,000. So I was supposed to be receiving 80,000. Now, in case the dollar fluctuates to 75, what I will receive is 75,000. So the loss of 5,000 can be covered. So I'll increase the prices of my products or goods which I have exported to compensate for that 5,000 rupees loss. So there can be a clause in the agreement or the contract between the exporters and importers that although the invoice is in a foreign currency, but if the exchange rate fluctuates adversely or even favorably, the price can be varied. There can be a variation in the price. You may also make a contract to adjust the price variation only in case of adverse movement. It always depends upon what your position as a vendor or supplier or a customer is. The more powerful you are in the business, in the supply chain, the better management or the better terms of negotiation you can achieve. So these are some of the ways you can go for netting, matching, you can go for an asset liability matching, etc. The different ways in which you can internally ensure that you have protected yourself from your exposure. So asset liability matching would also be ensuring that whenever the cash flows are in such a way that the same cash flows are inflows and outflows are matched so that the exposure is reduced or it's brought down to nil. But there are certain external ways also in which one can cover it oneself in the foreign exchange. So external hedging techniques, one of the very important one is using the derivatives. Now, derivatives are something which is deriving their value from an underlying asset, right? So, most properly or more popular derivatives are forwards, futures, options, and swaps. These derivatives can also be, you can also have hybrid derivatives like swap options, future options, so on. But these are the more prominent derivatives that we use, which are deriving their value from an underlying asset. This underlying asset can also be commodities, shares, or securities, but they can also be currency. So when you are talking about foreign exchange management, then you are talking about only the currency hedge or currency, how you will hedge the currency against using any of the derivatives like forwards, futures, options, or swaps. So we'll not talk about commodities or securities, but we will see how we can use currency futures, currency forwards, currency options, swaps, etc. to hedge ourselves against the exposure. Now, derivatives generally can be used for hedging, speculation, and arbitrage. But when we're talking about foreign exchange management exposure, we will talk about how we can hedge currency using any of the derivatives like forwards, futures, options, or swaps. Another important hedging technique is also money market hedge. When you do a money market hedge, uh, the technique is that if you have a certain foreign currency payables, you create a situation that you have exactly the same receivables in terms of amount and time. So amount and timing both should be same. So you create such a situation, exactly the same receivables with in terms of amount as well as timing. You create that situation by either borrowing or investing in the money market. So interest rates would be given at what price, at what rate of interest you can borrow, at what rate of interest you can lend. And basis that, you can create a situation where you have exactly the same receivables as much as you have the payables. So if you have certain things to pay, if you have payables, you will create a situation that you have receivables, exactly same receivables. Now, how are you going to receive something in futures, receive a foreign currency in future? When you actually lend somebody in that foreign currency. So that person, whosoever you have lended the money, that will repay with interest the same amount. So you will have exactly the same receivables. Similarly, if you had an exposure that you have receivables in a foreign currency, money market hedge, you will create a situation where you will have to exactly have same amount of payables and exactly at the same time. So why will you have payables? How will you create payables? By borrowing the money in the by at a certain rate of interest which is applicable. So money market hedge is also a very interesting way on which you can cover yourself from your exposure, right? Let's now look at some of the questions through which we will understand how forward futures, options, swaps, and money market hedge can help in managing this exposure. And generally, when you are doing the questions, it is possible that you are given all the four hedging techniques, all the methods are given, all information is provided, and you have to see that which particular method of hedging is most fruitful. Okay? Any questions, team, so far? Right. So I hope there is clarity. Now let's look at the questions which are related to hedging. XYZ Limited is an Indian firm. It has to pay Japanese yen. How many? 500,000 or zero point 0.5 million or 5 lakh. When? On 30th June. So first, when you're reading the question, get the concepts very clear, get the basic information from the question, highlight that, understand that. From there only your mindset will start developing that what you are supposed to be doing. So you are an Indian firm, you have to pay Japanese yen. So maybe you have imported something from Japan and he has payables. So the Indian person has Japanese yen to be paid 500,000 on 30th June. And in order to hedge the risk involved in foreign currency transaction, there are two alternative methods given here. One is the forward market and the other is currency option contract. So here we'll talk about options also. What is the date today? It's 1st April. These are the options available. Now from 1st April till 30th June, we have 3 months. So we are going to cover our exposure for the next 3 months. Payables after 3 months. So if it is a forward rate, we want to look at a forward rate, which is for up to 3 months. And if it is an option, we are looking for an option for 3 months. So the spot rate is 1.9516 and 1.9711, bid and ask. Whereas the 3 months forward rate are 1.9726 and 1.9923. So firstly, what rate do you need? You need rupee by yen. And because you have Japanese yen payables, you want the ask rate. You're going to buy the Japanese yen, so the applicable rate would be ask. Okay. Now, what is the rate given? Japanese yen and INR, it is 1.9516 oblique 1.9711. So, 1 Indian rupee is equal to 1.9516 Japanese yen. So, the rate that is given to you is yen upon rupee, right? Japanese yen divided by INR, 1.9516 and 1.9711. So, you need the inverse quotes. These quotes are direct quote. What are the rates given in spot? One point nine five one six oblique 1.9711. Inverse quotes would be 1 upon 1.9711 oblique 1 upon 1.9516. So this is the rate which is, just a minute, direct quote is not available to us, indirect quote is available to us. What is given to you is 1.9516 oblique 1.9711, and you need direct quote from this 1 upon 1.9711 oblique 1 upon 1.9516. Okay, this is the spot. Similarly, forward would be what? So, if you look at the spot rate, today you are end up paying this much multiplied by 500,000. But if you apply the forward rate, you end up paying 1 upon 1.9726 into 500,000. So let's calculate what is the outflow in spot. Though we don't need what is the outflow in spot because we are ultimately making the payment on 30th June. So 2,56,200, I've rounded off, rupees is the outflow if the payment had been made right away. But we are not making the payment right away. So the payment that is to be made on 30th June, if we had hedged ourselves using the forward rate, then the outflow would have been 500,000 divided by 1.9726. 2,53,000 472. You can see here which whether the currency is at a premium or at a loss, discount, right? So we had payables. We were paying 256,200, but now we end up paying how much? 253,472 because the rupee is at premium. So we end up paying less Japanese yen, right? So we for excess of balance, the second option is you can go for the currency options, strike price, call option, put option. And for excess or balance, the firm would use forward rate as the future spot rate. You're required to recommend cheaper hedging alternative for XYZ Limited, right? So as we have already covered in the derivatives chapter, options. So strike price is given. How much Japanese yen? 2.125 you have to pay for 1 rupee. Call option on Japanese yen has a premium of 0.047. Put option on Japanese yen has a premium of 0.098 Japanese yen. Okay. So whenever you are using options, you have to pay a premium when you are buying the call option or a put option. When you are a buyer of a call option or a put option, the premium is to be paid, right? Whereas if you were seller of call option or put option, you would have received the premium. So here we have to see which of the option will be applicable to us. Is it a call option or a put option? And we have also to be very careful. The option is available on what thing, what product or what currency is taken as a commodity here or as a product, and how much we have to pay. So the prices for foreign currency options are given. Japanese yen 2.125 and the premiums are given here. Further, it's being mentioned here for excess or balance of Japanese yen covered, firm would use forward rate or future spot rate. So whatever the forward rate is coming out to be, we will assume that to be the future exchange spot rate. So the rate comes out to be 0.00128. 0.5069. Okay. 1 divided by 1.9726. This will be assumed to be the ask rate for the yen after 3 months. Now, for excess or balance, why do we say excess or balance? So let's look at the concept. Whenever you are using a derivative, the first derivative forward is always a O2C contract, which means over the counter. So in forward contract, if your requirement is to, let's say, buy yen 3,50,973 even, for example, you can make a contract. So you had yen 3,50,973 as payables. So you can enter into a forward contract for exactly 3,50,973 yen. But if you're looking for a future as a derivative or option, they are exchange traded. So you will not be able to have a exact cover for 359.73. So let's say there would be a contract size. Things would be standardized. So let's say the contract size is 50,000 yen in futures. So you get yen futures, how many? 50,000 per contract. And how many yen futures do you need? 359.73. And 359.73, when you'll divide by 50,000, you will end up getting some 7 point something number of contracts. So how many contracts you need to buy to cover yourself for 3,50,973 yen payables? The number of contracts are 7.01946. So technically here you would end up entering into 7 contracts. So you will take 7 future contracts, which means for 0.01946, you have two options. You can leave yourself uncovered, that means unhedged, or you can cover through some forward market. Right? So 7 future contracts means you have covered yourself for 350,000 yen. And for the balance 973 yens, which is equivalent to 0.01946 contracts, you have two options. Either you can cover yourself for 973 yens in the forward market, or you can leave yourself uncovered or unhedged for that amount. So both the things are okay. 973 will not cause very much fluctuation. Maybe you can leave it uncovered also, or you can cover it. Alternatively, it is also possible that the payables were not 359.73. Let's say they were 375.973. Okay. So if 375.973 divide by 50,000, you would end up getting 7.51946, I think. These many number of contracts. Yeah. So now here the fraction was very negligible, so you can leave it uncovered or cover it against something else. Here you have again have options. Using this, either you can go for 7 contracts, or you could have also gone for 8 contracts. So you have overcovered here, and if it is 7 contracts, you have left yourself uncovered for 25,973 yen. Now, 25,973 is a big amount of yen payables. So you can either cover through forward remaining, or you can still decide to leave unhedged, or you can cover using taking 8 contracts, 8 future contracts, not 7. Right? So this is the scenario when you go for a future or option. There is a specific contract size, so it's not up to you that you will want 359.73 or 375.973, and you will not get exact that. So either you overcover yourself. So whatever the gain or loss in future, that you will not bear on 3,50,000 or 973 yen. You will bear it on 4 lakh yens. Here you will bear it on 3,50,000. So it's a call which you have to take depending upon what do you see, what do you expect the exchange rate fluctuation to be. So let's say what I would have done here, I have payables. So my fear is that yen currency should not be at premium. Yen should not be at premium against rupee. Otherwise, it will be a loss for me. So I don't want the yen to be at premium against rupee. Now, if my expectation is that it will not be, the expectation is that yen would be at a discount. Expected exchange rates is that yen would be at discount. I will take 7 contracts, cover myself for 350. For 25,973, I might leave myself uncovered, hoping that the exchange rate fluctuation will be in my favor, yen will be at discount. But if the market expectation is that the yen is at a premium, I'll go for 8 contracts. Alternatively, for 7 contracts, I can take a future derivative, and for the balance, I can go for to some extent to the option contracts, depending upon what contract size is available. So I'll just quickly recap what I have just spoken about all this so that you can consolidate. We are talking about hedging, that is managing your foreign exchange. So when you manage your foreign exchange, you have to hedge your exposure. Hedging can be internally done, or you can also do it externally. Internal ways of hedging is netting, matching, asset liability management, price variation, invoicing in your currency. There is also a concept of leading and lagging. So leading means you make the payment beforehand. So if you think that yen payables are going to be at premium, yen is going to be at premium. I don't want to make the payment on 30th June. I'll make the payment right away. If I lead the payment, I'll make it beforehand. But if I think that is going to be at discount and it will continue, so I might not make the payment on 30th June. I'll make the payment on 31st July, maybe August. So he may charge me some interest, but I'll be more than compensated because the yen would be at a discount. So these are also some of the internal ways, leading and lagging, making the payment early or delaying the payment if it is payables. And also in case of receivables, if you think the other currency is at premium and it is receivables, you would like to delay the payment, receipt of payment. And if you think that the other currency is at discount, you would like that the payment should be received as early as possible. So leading and lagging is also one of the ways. Then there are external ways in which hedging can be done. These external ways would generally involve using of derivatives, the use of derivatives. And secondly, you can also use money market hedge. When you use derivative, there are generally 4 derivatives available, which we will be discussing and doing a lot of practical questions on those. The first one and most popular is simple one is your forward, then futures, options, and swap. All have their own merits and demerits. Forward means you can exactly cover yourself for the exact amount of payables or receivables. They are over the counter and you can negotiate and you can set your own terms and conditions. Futures are exchange traded. Things will be standardized. Contract size will also be fixed. So in this, what happens is, let's say if the contract size is 50,000 and your payables or receivables are 50,000, 100,000, 150,000, 200,000, 250,000, 300,000, 350, anything that is exact multiple of 50,000. Only then you will be able to cover your exposure 100%. But if the total payables or receivables is anywhere in between these multiples, then you will not be able to cover yourself 100%. If the fraction is negligible, you can ignore it. For example, if it was 7.01946, you ignored it and you could have gone for 7 contracts. And if the fraction here would have been 7.998 something, you could have gone for 8 contracts, a little above the exact amount of currency you have covered. However, if it is 7.5 something or 7.4 something, it is your decision. You can go for 7 contracts and leave yourself uncovered for small part, like 25,973 in this case. You can also cover yourself beyond the exact payables or receivables. For example, here, if you take 8 contracts, that means you have covered for 400,000. So what will happen if you gain on future? The gain will be on 400,000 yen or 4 lakh yen. However, the payment would all go for only 375,973. So overall, you would benefit more. But if the futures are in loss, so the loss will be on 400,000 or 4 lakh yens, and the payables would be 375. So maybe it will cost you a little more than what you expected. Options are also one of the means. And when you are in between some fraction, you may decide to leave yourself unhedged. You may decide to cover yourself through some other derivative product or some other means of hedging. It could be option, future. Now, it depends upon options, forwards, or anything, money market. What you decide will depend upon what your expectations are. If you see a clear currency to be moving at premium or discount, you can take a call. But if you don't know the direction also, in that case, you may go for an option contract, which will help you cover if there is a need. So we'll discuss a lot of questions on this through which you will be able to understand, I'm sure. Let's give a break for 10 minutes here before we take up any question, right? Okay. The team, let's give a 10 minutes break and then we'll start. Okay. Thank you. All right, team. So we were discussing about this question where we are using two of the hedging techniques. One is forward rates and the other is options. So as far as forward is concerned, we have found out that we need rupee by yen, but what we are given is yen by rupee. So 1 upon bid will become ask. 1 upon 1.9726 is the rate which is applicable. This gives you 0.5069. So just how you round off, this is also important. 506945. Okay. So either you can use this digit and you can leave it at 0.5069, or you can see this is 5, which makes it 5. And because this becomes 5, this can become 0.5070. Right? So whatever you use, uh, that's up to you here. Now, ultimately, if you go by the first option, forward cover, the rupee payable becomes after on 30th June will be equal to 500,000 multiplied by 1 upon 1.9726. So when you multiply this, even then you get a figure, so you can round off that also, or you can keep it 25,3472. Okay. So this is your payables in forward cover, right? Now, when we are given an option to recommend, so we will compare this to 53,472. So how much is the forward cover payables? 253,472, and we'll compare it against option. Further, excess or balance will be used as this rate. So you could have also used 0.5070 directly. Had you used 0.5070, so 5 lakh into 0.5070, your answer could have been 253,500 also, right? Now, let's talk about option. So first thing important is it's a currency option. So how will you start solving questions on currency option? Number one, you have to see the option is on which currency. Option is for buying or selling which currency. Here it said the option says Japanese yen 2.125, let's say. So the option is on rupee. So if you want to buy or sell 1 rupee, the strike price is for 1 rupee you get or you receive 2.125 Japanese yen. Once again, indirectly, it is saying the quotes are yen upon rupee here. So it's an indirect quote and indirect option for us. The option is on rupee, but we are needing Japanese yen. It's not on Japanese yen. Second thing you will see, the option is on rupee, but your exposure is what? Exposure is yen payables. So if it is yen payables, it also implies that you have to buy yen. Indirectly, it implies you have to sell rupee. Agreed so far? When you're looking at the currency, it is sometimes a little tricky to find out the option is on rupee or yen. So I recommend you to always look at this. Let's say the price, there is an option on a particular stock, option on stock of ABC Limited. What will be the strike price like? The stock of ABC Limited is available, let's say, at 70 rupees. Strike price 70 rupees. Does it mean that the option is on rupee? No, the option is on this stock. So if the price is in rupee, the option would have been on yen. But if the price is in yen, the option is on rupee. Okay. So whatever the price, strike price is given, the option is on the other currency. Option is on Japanese yen. The price would have been, strike price would have been 0.50 rupee, 0.52 rupee, something like that. So first you have to see that the option is on which currency. Looking at the strike price you must be knowing can be represented by the capital letter X. Okay. So the strike price or exercise price is given as Japanese yen 2.125, which makes it clear that the option is on rupee. You can buy or sell rupee at Japanese yen 2.125. But what is your exposure? You have yen payables. So yen payable means you want to buy yen. Okay? Any questions so far? I hope it is clear. You want to buy yen. Buying yen is equivalent to selling rupee. Now, which option would be applicable if you want to sell or if you want to buy? So here you have to sell rupees. Which of the options will be applicable? Call or put?
Put.
Very good. So when you want to buy the yen, indirectly you are selling rupee. Option is on rupee. So you have to buy a put call. Put gives the option buyer right to sell the underlying whatever asset, here currency, at a strike price. Okay. And for that, you have to pay premium also. So first, let's see how many put options would you like to buy. Okay. So the strike price is 2.125. Total requirement was for 500,000 yen. So we need to buy how many put options to be able to sell how many rupees. 500,000 divided by 2.125. All right. So we need to sell rupees 253 294. 0.1176 technically. If we round off 1 divide by 2.125 separately, it comes out to be 500,000 into 0.470588. So I take 4706. So that makes it round up to 235,300 put options or rupee. Now, standard size is not given in the question that one contract is for 50 rupees or 100 rupees, how much. So we assume that one contract is for 1 rupee. So here we will be allowed to exactly buy 235, 300 rupees. We will be selling 235, 300, or we can take 235, 294 also. Okay. So far clear? How will you decide which option? So first you have to see which currency the option is available for. So, what is the underlying currency in the option contract? The underlying currency in the option contract is INR, Indian rupee. Why? Because the strike price is quoted in Japanese yen. So, if you want to buy or sell 1 rupee, you need to pay or receive 2.125 Japanese yen. That's the strike price. Your exposure is in yen. So yen is payables, which means you want to have asked for the yen or you want to buy the yen. Buying yen is equivalent to selling rupees. So for selling underlying, if you want to be a buyer of an option contract, it's the put option. If you had to buy rupee, that means sell the yen. Had you been an exporter, then you would have gone for a call option, right? So once again, look at this question. Price for foreign currency options are this. Strike price on rupee. Okay. Japanese yen 2.125. Call option or put options. So we have Japanese yen's payables in the sense we need to buy Japanese yen, therefore we need to sell rupees. Sell rupees means put option. If you want to be a buyer of an option, okay, you could have also been a seller of an option. In that case, you could have gone for a call option also. You could have sold call option. But if you want to be a buyer of an option to hedge yourself, taking sales position can be a little speculation. So that would can be very risky also. So whenever question is saying that you want to hedge yourself, hedge with being a buyer of an option. Okay. So being a buyer of an option, the suitable option for you is the put option. It also has a premium of Japanese yen 0.098 per rupee. Okay. So once again, firstly, we need to buy put option. How much? 235, 300. And we also need to pay a put option premium. And premium is 0.098. So total premium to be paid would be 235, 300 into 0.098. Premium on put option. So this answer is in yen, but you will be paying rupees. So these many yen is equivalent to how many rupees? You will use the spot rate. So you want to buy yen, and the applicable rate for yen would be ask. But because it is inverse, so your applicable rate would be 1 upon bid 1.9516, right? So you need to pay the premium. How much is the premium? For every rupee, 0.098. So this figure was in yen, right? So you need this many yen to be able to buy the put option. 235,300 into 0.098 yen. So your premium payable was, this is just for working, premium in yen was 23059. So how will you get 23059 or 23060? Round up, if we round up. How will you get the yen? By buying these many yen. So you need what? Ask. What is given? Yen by rupee spot. So 1 upon yen by rupee bid. It will become 1 upon 1.9516. Okay. So 23060 multiplied by 1 upon 1.9516. This will become the premium payable in rupee. Why are we using the spot rate here? Because premium is payable upfront. Premium on option will not be payable on 30th June. Premium would be payable upfront. So 11,815.94 rupees, which can be rounded off to 11,816 rupees, is to be paid as option premium. So total for payment of Japanese yen 500,000, the total rupee outflow would be under the forward cover 253,500 and under the option cover 235,500. So let's compare. Under the option cover 235,300 plus a premium of 11,860. Which one is better option? Which one is a better option?
Option cover.
Option is a better option. So we'll say the outflow under an option cover is less than the outflow under the forward cover. Therefore, we will hedge ourselves against the for the Japanese yen exposure of the Japanese yen using the option cover, option contract. Now, there are 2, 3 more aspects which need to be discussed with this question. Number one, is this a precise answer? No, because there is one problem in this answer. This 253,500 is going to be an outflow on 30th June, right? No doubt about it. Why? because under option forward cover, there is no forward premium you are paying right away. All that you pay is after 3 months. So today is 1st April, and you're going to make the Japanese yen payables has to be done on 30th June. So under the forward cover, 200, 500 will be paid on 30th June. Whereas if you look at the option cover, the option you will decide whether you want to exercise or not. You will decide on 30th June. If you find it favorable, you will. And when it will be favorable? When the rupee is being sold at this. If the price of the rupee in the market is more than this exchange rate that comes out to be 1 divided by 2.2125, I guess, right? 1 divided by 2.125, sorry. 2.125. This is the exchange rate. This is the rate that is coming for the rupee, which is, so you are going to sell rupee for 0.470506. If the price of the rupee is more than this, greater, okay, greater than 0.4706, you will let the option lapse. Option is not a compulsion for you to exercise. It's a choice. It's a option for you. It's a not an obligation, but it's your right. If you want to exercise, you will. And if you don't want to exercise, you can let it lapse. You will lose the premium of 11,816, but nothing else. So the rupee is being sold for 0.4706, right? However, if the price of the rupee is more in the market, more than 0.4706, you will not use the option, you will sell it in the market. So then you will end up getting more yens against this. Now, if this has to be more, we can also say that if the yen depreciates further, that means if it is more than 2.125, it goes for 2.3, 2.4, then you will not use the option cover. Okay. So options you can allow to lapse also. It's not a compulsion that you have to follow the option. You can let it lapse. The second problem under option is that 235,300 outflow will be on 30th June, whereas 11,816 is an outflow which is on 1st April. So that's an anomaly here. The option outflow will have two parts. One, when you exercise the option. So when you are exercising the option or exercising put option, you are actually selling rupees and you are getting 235,300 on 30th June. You have to pay 35,300 when you have these options. Okay. And then there is a premium which you have to pay, which is 11,816. This premium will be paid on 1st April. So one thing you can do is 11,816 can be brought to 30th June by adding some element of interest. So comparison should be at one point of time only, not at two different positions. However, as the question has not given us any interest rates and any contract size, then we can ignore the two things. So when you're doing this question, I would like that you write two assumptions here. Number one, that it is assumed that the entire amount of Japanese payables were covered using the option. So there was no excess or balance because standard size of the option contract is not given. Secondly, the premium which is paid on 1st April we are ignoring the interest cost, or we are not bringing it to 30th June, right? So Sanjay and Leela, both of you, is it clear?
It's clear,
Everyone? Okay.
clear.
Clear, ma'am.
So once again, I'll quickly recap. There are two options in which you could have taken the hedge. One is the forward cover. The second is the option. Forward is simple, 3 months forward. All you want is a 3 month forward rupee by yen ask. However, the rate givens are yen by rupee, so you need to inverse the quote. Therefore, 1 upon bid will be your answer. Using this, you will find out how much is the rupee payables under the forward cover. So the total outflow would be 253,500. So you have to pay the Japanese yen 500,000. For that, you will pay in rupees 253,500. Second is the option cover. Under option cover, first you have to be very careful. You have to see the option is on what currency. Because the strike price is in yen, the option is on rupee. Okay. So yen is supposed to be bought. You have to pay the yens. So for that, you have to buy yens. Therefore, you will sell the rupees. Selling rupee means you will sell the rupee, you need to have a put option. So when you are selling rupee, you need to sell how many rupees? 500,000 divided by 2.125. So you get a contract for selling 235,300 rupees, and you will end up getting 500,000 yen to be able to make the payment. So 235,300 should be your outflow. But for that, on 235,300, calculate the premium as well. Premium would be in yens, 235,300 into 0.098. Convert the yen into rupee using the current spot rate of the yen ask, because premium is to be paid in yen. So this is 11,816. But the two problems here is that 11,816 rupees is to be paid on 1st April, whereas the rupee which you will sell under the put option has to be paid on 30th June, 235. So total outflow would be 247,116, ignoring the interest on 11,816 for 3 months. Okay. Final answer. Outflow under the forward cover, 253,500. Outflow under the option cover, 247,116 rupees. Therefore, the outflow under the option cover is less than the outflow under the forward cover. Therefore, it is recommended to follow the option. Another benefit in option is that it is not compulsory. So if the exchange rate moves more in favor of the uh, importer, he will stand to benefit further under option, because it's not a fixed amount which you have to. Japanese yen move more than 2.125, then the rates will also further reduce for the rupee, and you will have to pay lesser rupees then. Outflow will be further less, and one can take the benefit. So in this particular question, option cover is clearly the right or the recommended path, because even if the prices move more favorably for the importer, then then it will be even more beneficial. But even in the existing situation also, this is beneficial. Now, supposing if this comes out to be 253 600 or 253 510, then maybe you are paying more under the option cover. Recommended is forward. However, if option will give you a choice, so you can still write that line that, however, under the option cover, there would be a choice. So if the exchange rate moves differently from 2.125, if they increase beyond 2.125 in yen, that means the rupee would become at a premium and the outflow will be less. Okay. Moving on to one more question. ABC Technology is expecting to receive a US dollar 400,000. You have dollar receivables. When? After 3 months. So if you have dollar receivables, your fear is that dollar should not be at a discount. If dollar is at premium, you are happy. Dollar should not be at a discount. Company decided to go for a future contract to hedge against the risk. So we have seen how forward contract works. We have seen how options work. We will this time see how future contract works. So first thing in future contract is that there is a contract size because of which the number of contracts may come in fraction. So you have to take a decision, you have to take a call. How many contracts you want to buy. So if you round it off to the next higher multiple, means you have taken the future contract for more amount, you have over covered yourself. But if you let it round off to the lower multiple, lower integer, then it means that you have remained for some portion unhedged. Now you have to take a decision whether you want to remain unhedged for that or you want to cover it under the forward market or the option market. So the company goes for a future contract to hedge against the risk. Standard size of the future contract is available is 1,000. So here, luckily, number of contract is not a fraction. So you are completely hedging yourself for $400,000. So number of contracts are 400. As on the date, spot and future dollar contracts are quoting at 44 and 45. So this is rupee by dollar. So you need a direct quote only, and you have got a direct quote for this, which is rupee by dollar 44. As on date, spot and future. So spot is 44 and future is 45. Dollar futures. Okay. So your currency is dollars and you have dollar futures. So because your fear is what? That the currency should not go down. It should not decrease, right? That means at present it is high. It should not go down. Suppose after 3 months, the company closes out its position, futures are quoting at 44.50 and spot is also quoting at 44.50. So this is today and future. That means exactly after 6 months, the quotes are 44.50 and 44.50. Team, you will see one thing that future and spot should converge after 3 months and they are 100% converging, which means there will not be any basis difference here. And because the contract size is also same, you will somewhere find that the outcome of this is will be exactly what is under the forward contracts also. You require to calculate effective realization for the company while selling the receivables and calculate how the company has been benefited by using the future option. Okay. So firstly, you have dollar receivables. You are fearing that the dollar price may not come down. That means at present you're thinking if it is high today, it will come down in future. So something which is high today and will come down in future, you will like to buy or sell. If the price is 100 today, you think it will go to 110. Or if the price is 100 today, you think it might not go to 90. Okay. If this is the scenario, would you like to buy something here or sell? This one would be a benefit is in buying because the prices are likely to increase. Here, the benefit is in selling because the prices are likely to decrease. So, because you have receivables and you are hedging to cover fall in prices, you will sell the future. Is this clear? If you have payables, you are fearing that the price may not go up. So in that case, you will like to buy the futures. But if the prices are likely to fall, that is what you are fearing, that the prices may go down, you will likely, the chances are that the price may come down. And because you have receivables, you will like to cover yourself by selling the futures. Okay. So in this question, number one, what is the contract number of contract? Dollar receivables divide by contract size. 400,000 divide by 1,000. So number of contracts are 400. So first thing is, what is the contract? Number of contracts? 400. Second, how will you do the hedging? Since it is dollar receivables, sell 400 contracts of dollar futures. Okay. Third, gain on loss on futures. So something which you have sold for how much? 45 is now available in the market for 44.50. So how much is the gain? 0.50, 50 paisa. 50 paisa on each dollar, whereas you have taken 400 contracts of $1,000 each. Okay. So what is your gain? 400 into 1,000, that is 4 lakhs into 0.5. So you have gained 2 lakhs. And spot rate after 3 months is also 44.5. So amount realized on selling the dollars from dollars which are received, 400,000 multiplied by 44.50. 1 crore 78 lakh is what you will get from the spot market by selling the dollars, plus another 2 lakhs from the future gains. So your net inflow would be 178 plus 2, 180. Okay. So what was the future price? 45. So what are you likely to get if the price remains 45? 400,000 into 45. What were you supposed to get? 1 crore 80 lakhs. And how much have you got here? 178 plus 2 lakhs. So 1 crore 78 lakhs plus 2 lakhs. You have got exactly 1 crore 80 lakhs. Why have we been able to fix this 45? This is for two reasons. Number one, contract size was perfect. No fractions here. Had this been 400 point something something, you would not have got exactly at the rate of 45. And secondly, the spot and future prices converged after 3 months. The spot and future prices converged, exactly converged after 3 months. There was no basis difference. That's why you have been exactly able to fix the 45 rupee rate. Generally, in futures, it does not happen. So, what do we do in futures? What is the trick to do the questions on future? Number one, identify the exposure. So, here the exposure was in USD. Second, identify whether it was receivables or payables. Your second step should be that you are able to identify whether the US dollars was a receivables or payables. In this case, you had dollars receivables. Number three, you will see futures are available for which currency. So is it dollar future or rupee future? So here it is available for dollars or your home currency. You have to be very careful. So futures was available for future dollar contract. Futures was available for dollars. Now, because you have receivables, you will sell dollar future. But if the futures were available on rupee, you would have done the reverse, you would have bought. So this makes us clear that what is our hedging strategy, that we will sell dollar future. Okay. Fourth step would be to find out the contract size, number of contracts. How do you do that? Total receivables divide by the contract size. So you have taken $400 future contracts, 400 contracts. Then this is all which you have to do on the present date. After having after having sold $400 future contracts, each for 1,000, after this you will move 3 months later. After 3 months, what you have to do is whatever your receivables are, you will sell it in the spot market. What is the rate? 44.5. So how much you will get? 400,000 into 44.5. And you will calculate the gain or loss on futures. So what is the difference in the future price? It has moved from 45 to 44.50. You have sold for 45, but now the price is 44.50. Your sell price is fixed at 45. So you gain. If the price decrease in the future and you have sold something, you stand to gain. So 45 minus 44.50 into 400 into 1000. You are gaining 50 paisa on each dollar, and you have taken a contract on $400,000. So 400,000 into 50, you gain 200,000 or 2 lakhs. So how much did you receive from the spot? 400,000 into 44.5 plus 2 lakhs. Net what you have received is 2 crores. You can see that if the future prices fall by selling, you gain. This is what you were expecting, that you were fearing that because you have dollar receivables, the price of dollars may not fall. Therefore, you sold the future dollar futures. So receivables was 400,000 by 1,000, 400 contracts. You have to sell 400 contracts of dollar futures. Price moved from 45 to 44.50. So you gained 50 paisa here. 50 paisa into 400 contracts into each contract of $1,000. Total gain on futures is 200,000 and spot is 44.5. So amount realized from selling the dollars received is 1 crore 78 lakh. Total inflow 1 crore 78 lakhs plus 2 lakh is 1 crore 80 lakh. Okay. In this question, there is no premium you have paid for future contract or anything. Sometimes maybe some amount may be charged. For that, once again, you have to ensure that you borrow it, or you have to ensure that it reaches exactly 3 months. So, like in the previous question, in the option contract, we needed 11,816 rupees. We could have also borrowed those 11,816 and repaid together with interest after 3 months. So, in that case, the total outflow will not have two segments, one on a particular date, one at present, and one at a forward date when the actual dollars are received or when actual yens are to be paid. Okay. Any questions here? Is it clear, Sanjay, Leela, both of you, everyone?
Yes, ma'am.
It's clear.
Okay. Next, we talked about money market instrument or money market hedge. A very interesting concept, does not involve any derivative. Columbus Surgical Incorporation is based in US. Why did I know that this is a money market hedge? Rate of interests are given there very clearly. So it's my anticipation that this question could be of money market. So Columbus Surgical Incorporation is based in US. So your home currency is US. Imported surgical raw material from the UK. So it deals with UK. He is an importer. That means it will have payables in pounds, right? If particularly the import currency or the invoice currency was pounds, it must be, let's see. So Columbia Surgical Incorporation, based in US, recently imported surgical raw materials from UK, invoiced 480,000, payable in 3 months. So let's look at the exposure of this company again from all the angles. Pounds, payables, 480,000. Uh, though you will not write in the exam using a pen, but you can write using a pencil here and then you can later on erase it. That because you have pound payables, you are fearing that pounds should not be at premium. Your fear is pound may increase. It has also exported surgical goods to India and France. So dealing with any other currency also, which is country, which is India and France. But from India and France, it has receivables because it has exported to these countries but imported from UK. So in India and France, it is receivables, but in UK it was payables. Let's see which currency the invoice was. The Indian customer has been invoiced pound 138,000 payable exactly after 3 months. Timing is matching, amount is not exactly matching. Pound receivables from India exactly after 3 months. How many? 138. So we can do the netting here. Timings are exactly matching, so you can do the netting. Exactly after 3 months, there would be payables, right? 480,000 pounds payables, 138 receivables, 480 minus 130, 342 payables. So the fear is again still that the pound may not increase. Okay. And from the French customer, he has been invoiced euro 590 payable in 4 months. So third is euro receivables. The word written is payable, but we know that this US company has exported surgical goods to India and France. So Indian customer has been invoiced in pounds payable in 3 months, and the French customer has been invoiced in euros payable in 4 months. So here there is some difference of timing also. Euros will come after 4 months, 1 month after the pounds are paid. So these are receivables. So for euro, you are fearing that euro may not decrease. Current spot and forward rates are given. Spot against pound now and 3 months. Pound and uh, dollar and euro now and 4 months. And there is also money market rates in UK, France, US. You, as a treasury manager, are required to show how the company can hedge the foreign exchange exposure using forward markets and money market hedge and suggest which is the best hedging technique. So we will be comparing. In the previous question, we compared forward with option. Then we learned what is the future contract. And now in this question, we're going to learn money market and we are going to compare money market with forward. Okay. So firstly, what is given to you is it a direct quote for US or indirect? 1 pound is equal to US dollar, or is it 1 US dollar equal to how many pounds? Is it a direct or an indirect?
Indirect.
For from whose perspective are we going to look
US.
at this?
US.
From the US. So from the US, the direct quote would be dollar on foreign currency, right? So this would have been the direct quote. But what we are given is indirect quote. So it is pound by dollar, right? So we need to convert it into a direct quote. All right. For pounds, we have net what? Payables. Under pound, what do we have? Net payables. So we are not required to hedge for 480. 138 has been hedged internally because of netting. We need to hedge only how much? 342,000 pound payables. Okay. So we need to buy the pound. We need this direct quote. We are given this one. Payables means ask rate is applicable. Okay. So we want the direct quote ask rate. And we want the forward. For hedging, what is applicable? Forward. So what is the rate applicable? 342. So in order to pay 342,000 pounds, we need to pay how many dollars? 359,243. Net dollar payable 359, 243 or $244, round about. Okay. You could have also done 1 divided by 0.9520, whatever the fraction comes, you can round off that and then multiply 342,000 into that. Figure whatever you get after rounding off. You might get a slightly different answer. So 245 would be a better rounding off in that situation or anywhere, right? So these are the dollar payables, right? We have covered already. US person imported surgical equipments from UK, so it had pound payables. But after receiving 138,000 pounds, net pound payables were 342,000, for which you are going to cover under the forward market. Forward market applicable rates were this, bid and ask. However, you needed the dollar by pound ask. Given is pound by dollar, so 1 upon 0.9520. Okay. So after 3 months, what is your outflow? That has been covered. Next, euro. Do we have euro rates? Right. So US dollar to euro rates are given spot 1.8890 and 1.8920 and 4 month forward. Now this one is given very directly. That means how many euros you have to be receiving. And the French customer has been invoiced at 590,000 euros. So you have euro receivables after 4 months. So you will have to sell the euros. Bid rate would be applicable here. So you need dollar by euro bid, right? euro receivables after 4 months. Dollar by euro bid forward 1.9510. This is given directly. So the total euros after you will receive is 590. €590,000 multiplied by $1.9510 per euro. So this becomes, I guess there won't be any issue of rounding off this because direct rates are given with 4 decimals. So same would be as it is applicable. 11,51,090 dollars. So under the forward contract, it is clear that after 3 months, it will pay $359,244, and after 4 months, it will receive $11,51,090. Let's now understand how money market hedge will come into picture. Firstly, we have identified two things. I'll use a different coloring so that you understand better. We have identified that you have pound receivables. Okay, 342,000 after 3 months. And second, you have identified euro payable. Sorry, we have pound payables and euro receivables. Euro receivables, 5,90,000. This is after 4 months, right? So two things we have identified. Pound payables after 3 months and euro receivables after 4 months. Now, if you want to use a money market hedge, let's take first with the pound payables. Create a scenario where you have exactly 3,42,000 pounds receivables. So you receive exactly 3,42,000 pounds after 3 months. You have to deliberately create this situation where you will have exactly 3,42,000 pounds received after 3 months. Now, who will give you 342,000 pounds exactly after 3 months? If you make a investment in UK, okay, for 3 months. So either lend somebody in UK or make an investment in UK for 3 months and liquidate that investment exactly after 3 months. So what will happen? Exactly after 3 months, you will receive 3,42,000 pounds. Now, Is UK giving any interest? Yes, it is. So do you need to actually make an investment of 342,000 to receive 342,000? No. You want to receive 342,000 together with interest. Now, if you want to receive that amount together with interest, you only need to make an investment of its present value. How much is the rate of interest prevailing in UK? It's 10% and 12%. So this is the rate applicable for a lender. A lender will get 10%, but a borrower has to pay 12%. Same spread is applicable here also. Okay. So by making an investment, are you a lender or investor or a borrower?
Borrower.
You have to make an investment. You are not borrowing.
Okay, yes, lender.
You are lending it to somebody or you are investing. So you applicable rate for you would be 10%. These are per annum. Okay. Now 10% per annum means how much for 3 months? 2.5%. Okay. For 3 months, applicable rate is 2.5% interest rate. Agreed so far? How does money market hedge works? It works like if you have payables, create receivables. If you have receivables, create payables. Now this question has both the things. We have payables also and receivables also. Payables in pounds and receivables in euro. So we will use perfectly understand how money market hedge works. So after 3 months, you have pound payables. So create pound receivables exactly 342,000 and exactly after 3 months. But for creating a receivable in pounds, you need to make an investment today in UK. For making the investment in UK, you will get 10% interest. For 3 months, it will become 2.5. So how much do you need to invest? The present value of 342,000. Okay. I will erase the forward cover, I guess. That must be clear to you. So in order to use money market hedge, lend 3,42,000 divide by 1.025. Is it agreed? The present value of pound 342 at 10% per annum lending rates or investing rates in UK. Okay. So you need to invest 342,000 divided by 1.025. So you need to invest 333,658 point something. So 659 or I can take 660 also. approximately these many pounds. So where are these pounds? We don't have it. So what will we do? We will get these pounds from the spot market. Pound ask. What is the pound ask? 1 upon 0.9830. So you will need these many dollars, equivalent to 333,660 divided by 0.9830. Is this clear? These will then be converted to dollars using spot rate. So you will need to pay these many dollars to be able to get 333,660 pounds. So you need how many dollars? You need $3,394.30 approximately. Okay. So if you had this much money, why would you wait to make the payment? You would have made the payment right away. You don't have this money. That's why you are wanting to making the payment after 3 months. So if you want $3,39,430 today, then you have to borrow it. Borrow from where? USA. Rate applicable 13%. Okay. So you will borrow it at 13% per annum. For 3 months. So how does the money market hedge works? Now is it clear to some extent? We had pound receivables. We will create exactly pound payables. So we will create receivables 342. For 342, we don't need to invest 342. We need to invest 342 divided by 1.025, as in UK, the lending rates are 10% per annum. But we don't have these many pounds. So we will get these pounds by exchanging with dollars today. What is the exchange rate? It is 342,000 divided by 1.025 divided by 0.9830. So you will borrow these many dollars from the US market at 13%. US market will give you at 13% borrowing rates for 3 months. So this amount is what you have borrowed at 13% for 3 months. And this you will end up paying exactly after 3 months in USA. So 339,430 into 1.0, 13% for 3 months, 6.5 and 3.025. So you end up paying 3,50,461. Okay. What will happen? You will borrow it. You will invest in US, borrow from US and repay together with the US person. What will happen? Whatever the investment is, that from UK you will get 342 with which you can make the payment. Right? First, if you have any questions, let me know. Otherwise, I'll continue with this example. Can we quickly decide? Do it as an homework. You have it in the assignment sheet. Complete this question, present it well. And if you have any problems, we'll take just a quick glance. How are we going to cover the euro receivables after 4 months? So because you have euro receivables, you will create a scenario in money market hedge by ensuring that you have euro payables. Now, why will you?
Madam,
Yes.
yeah,
Yes.
how much time it will more take?
2 minutes, sir.
2 minutes. Okay, then.
Yeah.
No problem.
So you have euro payables, you have to create euro payables. Now, if you want to create euro payables, borrow euro now. How much is the rate in France? 16%. So you have to borrow at the rate of 16%. Okay. How much euros you will borrow? So that you have to pay 590,000, your receivables and 590. So 590 divided by 1.04 is the present value that we will borrow, so that after 3 months, say 4 months, you exactly pay 590. Now convert the euros into dollars today and invest in dollars at 11.5. Make a comparison and find it. Okay. So I wanted to take a MCQ. Just do this one, please, quickly, and let's see what is the answer. Annualized forward premium from 83 to 83.30. What is the answer? No one? Sanjay? All right, give the answer to this question also in the next class. I'm stop sharing from now. We'll take up later. Any doubts, any questions? All right, that's all from my side for today. Okay.
Am I audible, ma'am?
Yes, you are audible, sir.
Okay, students. With this, we come to the end of this session, today's session. And in this session, the overall coverage was of the interest rate parity and purchasing power parity and a Fisher effect. Now, if you recall that this Fisher effect has also been used while we were discussing the concept of inflation in capital budgeting decision, because there the concept of nominal interest rate is also applied. Nominal discounting rate, where we adjust the inflation plus real rate. Okay, so the logic is not only this Fisher rule is not only applied in a foreign exchange, it is also applied almost we can say normally in many areas. So it is one of the very important aspect. Now next, one of the very important aspect today has been covered is a money market hedge. Now money market hedge is also very good because you have in the last question you have seen a case where both where the payables is also there and receivable is also there. Am I correct, madam?
Yes, sir.
Yeah, so in this situation, it is a kind of a, we can say it is a kind of a study of an export house, or we can say a very big business which who has a import as well or export as well. So both things have to be managed by using the money market hedge. So students, thank you very much for your patient listening. And Anjali madam, thank you very much for spending your precious time and enlightening the student.
Thank you,
Now
Ashish.
I think some MCQ has been left, only one MCQ has been started, but the time is over now. So
Yes.
no problem. So I think in the next class, we will continue this topic as well.
Right.
Discussion.
Hmm.
Okay, madam. Okay, madam. Thank you very much. And see
Thank
you.
you.
Thank you, students. See you in the next class. Meanwhile, you prepare whatever we discuss, and madam, just share our telephone number as well as our email ID.
Yeah.
Mm-hmm.
So, sir, can you just once again, it was 0120
0120
3.
3045 045 956. And our email ID is sfm-final @ICAI.in. Okay, student, if you can send your query to this, or you can control. Although today or tomorrow maybe I am on leave, so I may not pick up your phone. So it will be better if you send the query through the email. Okay, student, thank you very much for the
Thank you, sir.
question. Thank you,
Thank you,
madam.
students.
Thank you, madam.
Bye.
Thank you. Bye.
Thank you, ma'am.
Thank you, ma'am.
Thank you, thank you.
Thank you, sir.
Thank you, madam. Thank you.